Good afternoon, everybody. Welcome to the afternoon edition. I don't know if we're calling this Coffee and Crypto, what we're going to call this, but it's our live stream where we cover the Fed announcement. We went live a little early because we were having some really good conversation here in the on the set before, and we're like, well, why don't we go live early and engage with the chat and let them hear some of this? But I'm joined by three of my favorite people. So I got T-Shroom on my right, I got Smay as normal, but I'm also joined by Caleb Franzen again. How are you gentlemen doing this afternoon? Long time no see or hear.
I'm doing great. Doing really great, Tim.
Good. Are you doing better than you deserve, though?
No.
No. Okay, good.
Why would you say that?
I don't know.
I'm doing about as equal as my deserving.
Good, Smay. How that? You guys see that Reels on Reels came out?
Yeah, exactly. Apparently, it's really bad according to Tim, but
Listen,
I thought it was good. I thought it was good. I reviewed Nope. It's a short, and I have 6 more on the way. So just be ready for it. But. Anyways, we're joined by Caleb, one of my favorite crypto analysts, stock market analyst, and the whole space. So how are you doing, Caleb?
Doing great, guys. Good to be with you again. Super excited. Basically another minute or two until we get the official announcement. So
it's true. Yeah.
I think it's about a minute and 1 minute.
5 seconds.
You know, before we went live, Smay was saying, Caleb, that you are his favorite Caleb of all Calebs.
Go to my screen.
Yeah, you are my favorite Caleb.
I love that.
Smay, go ahead, go to my screen. It'll print here in just a sec.
It'll print.
No. You want real quick before we go live, Smay, do you want to? Well, before we go live with the number, sorry, you're right. We're live on the air. Do you want to read green names? Your favorite thing to pump up your afternoon?
Yeah. So I actually only see a couple. So we have Crypto JMP. We have GS. We got JoJo. We got Crypto Set Guy. We got that's about it. Actually, that's it.
Good.
I expect
short and sweet.
Short and sweet.
Well, guys,
there we go. 2.5.
2
just as forecasted, so 75 basis points.
2.5, yeah.
I was wrong.
Yeah, because we went from 1.5 to 175, so now we're at 225 to 2.
Yeah, and that was printed 42 seconds after 2 p.m. exactly Eastern time. So pretty expedient here.
I'm a goober.
DailyFX.com.
Yeah, let's start with who is surprised by those numbers. If so, say I. May, why aren't you saying
cricket?
I'm not surprised.
2 minutes before we went live, you predicted that you would see 100.
Yeah, but I'm not surprised about it. I was just trying to be that one guy that's like, if it was 100, I'd be like, whoa, boom, I called it. It's 100.
Goodness gracious.
I was the only one. Yeah.
Well, let's go. I mean, so the number is officially in, and it's not that it's surprising, but let's go ahead and break this down. Caleb, what are your thoughts after seeing this number? And I know, some of this is going to be repeating from this morning, but right before we went live, we were actually discussing what we think that Jerome Powell's remarks are going to look like. So I want to throw it to you, Caleb. What do you think Jerome is going to come out and say, and what should we be expecting? Those of us now that we have these numbers here, we're going to have to wait to see both the August, well, I guess it's going to be the July numbers and the August numbers before we finally get another interest rate hike of any kind in September. What do you think we should be expecting after seeing 75 basis points for the month of June?
So 2 things as I read this press release stand out to me the most. The first is the third sentence, quote unquote, says inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Basically, the Fed is kind of stating the obvious. It's no secret that inflation continues to remain elevated, and they're basically continuing to stress the importance and significance of trying to kind of combat this historic environment that we're in. I think the second thing that stands out to me is the fact that they're saying, in addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. So this is really interesting to me because certainly they've put a cap on their principal reinvestments. However, the Fed balance sheet is still ridiculously large. It's fallen 0.7% from the year-to-date highs and the all-time highs. So it's strange to me that they're using this language that it will continue reducing its holdings because we haven't really seen them reduce their holdings by any significant degree.
Yeah. This is gonna be interesting to hear. Go to my screen real quick here, Smay. We're gonna jump over to the charts. If you guys aren't looking at the charts, we are now what time is it right now? 2:03. Well, guess what? We have 4 pretty decently green candles on the Minley chart. We're over 22,000, man. We're not done. Doesn't look like we're done climbing. So for those of us who are saying this price, let me go to the 4-hourly chart so we can see more candles. For those of us saying that the price was already, let's just go auto. Man, my mouse wheel scrolled. Yeah. Those of us saying the price was baked in, You know, they could have said like the price is baked in. This coming back down was just kind of cooling off. The bears cooling off, and maybe there's an outside chance we're seeing 100, but definitely looks like at least right now this has been a bullish sign. It is going to be interesting to see what Jerome Powell says, and this is kind of what Caleb was even talking about there, and I was saying this a couple days ago. I thought the bigger piece of information is going to be the press conference itself. And that's what we're going to talk about here a little bit. I just, I've talked to a couple different people now that are of the persuasion that, again, if you guys are watching the Coffee and Crypto show this morning, there's a difference between the world of reality and the world of data. So reality is the economy is in trouble. The reality is the dollar is ridiculously, dying. The reality is that people are struggling to provide and put food on the table. But data is showing the job market is still very strong. The data is showing, or at least what they want us to believe, is that inflation is a little bit inflated. The numbers are inflated. It's not actually that bad. Some have even gone so far as to say, and I'm going to say there's intelligent people who have taken this opinion that inflation has peaked out and we're not going to see a higher number than 9.1 again, at least during this recession or whatever we want to call this. So some people are predicting that Jerome Powell is going to come out with, more of a dovish move, saying, "Hey guys, we're going 75. We thought one more good push would do the trick, but in September we'll monitor the numbers, but we're going to give you some good hope for September to be 50 basis points, and then after that we'll kind of evaluate down the line." But I want to throw that to Caleb because Caleb was saying that's not what he thinks. And I don't even want to say what you said before the stream, Caleb. I want to throw it to you. What do you think Jerome Powell's remarks are going to be? Is he going to give us a hope for lower numbers in the future? Is he going to come out hawkish and give us maybe some fear, pump some fear into the market and say, "Hey guys, we're really looking like we're in trouble"? What are your thoughts about kind of the emotional state he'll leave us in at about 3 o'clock? So
I think there was a really good argument to be made that the Fed should be hiking rates by a full 1% this meeting. As you pointed out earlier, they're not going to have another FOMC policy decision until I think it's like September 20th, something around there.
Yeah.
So we're going to have two very important CPI prints for the month of July and August prior to that meeting. And so the Fed right now, because they're only hiking by 75 basis points, right? I can't believe we're saying this. They're leaving a lot of room on the table, in my opinion, from now until September, right? Because what happens, let's just say theoretically, if inflation does not slow down, right? Because on the contrary, we've seen evidence that inflation is only continuing to accelerate higher. So we're at 9.1% right now. The month before that was 8.6. The month before that was 8.3. And so what happens if in the month of July and then for August, we get up like above 9.5%, right?
Right.
Well, if the Fed only did 75 this meeting, right, the Fed is going to, that would essentially show, hey, these 75 basis point rate hikes that we've been doing since June aren't effective. They're not slowing down inflation towards our long-term target of 2%. And so if we see that scenario unfold, then that would be very damaging for the Fed's credibility. So I expect to see Powell remain very flexible in terms of the forward guidance, but come off as being very aggressive in the tone and rhetoric to assure the market that if we see inflation remain hot, remain historically elevated, we are here to do more, right? On the contrary, though, final thoughts on this. Yeah. What if we do see inflation roll over materially from here on out? If we see for the month of July and August, let's say inflation falls back below 8% on a year-over-year basis, that would be very, generally indicative that the Fed's policy rate hikes are being effective in muting inflation and bringing it back towards the long-term target. Still shows that there's a lot of work to be done, but maybe they can take their foot off the pedal a little bit and revert into those 50 basis point rate hikes.
Yeah, and I have an interesting question I want to ask you, Caleb, here in a second, and I want to hear T. Shroom's answer as well. But first, I want to throw the exact same question to T. Shroom. What are your thoughts? What is your belief about what's the emotional feel we're going to get from Jerome Powell here in a little over 20 minutes from now?
Well, I think he's going to feel a little bit more in control. I think he had a lot of analysts come out and kind of predict that this is peak inflation, that June was peak inflation. He's going to have a little bit more confidence now that those stories have kind of reverberated through the market. But I think he also does have his vision on the long term, right? He's also realistic. He knows that there's a big chance that this isn't peak inflation. So he's going to have to do the hard work too of getting up there and being honest and answering these really tough questions that the journalists love to ask him.
Yeah.
But I think he's going to have a little bit more confidence, and we'll see how quickly that confidence rubs off and becomes, just having to get in there and do the work. But, he's got this, he stuck to his guns, did 75 basis points, what everybody was expecting. I think that for a large part of the market, they're going to see this as good just because it's consistent, not because it's, it's interpreted as dovish or hawkish, but because it's consistent. The Fed has historically been consistent. Once they find a hike or a decline that they like, they stick with that number until they have reached their goals. So I think it's kind of he's also going to derive confidence from that, knowing that he's been able to project consistency. But if the market begins to react negatively and was signaling that they did want a 100-point basis hike, then he might have to backpedal a little bit, especially if that bleeds into some of the questions. So, but I'm thinking overall, I think he's going to be confident, and we'll see how long that lasts.
Real quick, and check them out with the charts. Smade, go to my screen. We shot up here, and we got as high as 22,200, and then this is a 5-minute chart, by the way. We dropped back down to about 21,800. We're climbing again, though. We're hovering right below 22,000, so we'll keep checking in on that price throughout the next 30 minutes before we get to hear Jerome Powell. But my question I wanted to ask, and so we talked about it this morning on Coffee and Crypto, Caleb, and I'm really interested to hear your thoughts on this. So something that you said this morning, and I think it's good, but I want to kind of wrestle with it a little bit, and I want to explore the narrative of the weight of why they would have it, their concern, and that is you talked about their concern with their credibility. So the Fed is concerned that if they don't take this seriously and they don't do things correctly, their credibility can be hurt. What is the significance of the Fed having credibility? First of all, I would ask, do they have credibility to begin with? Second of all, who are they trying to appease to make happy to get credibility with? Because they're not an elected position. So it's not like we, the people of the United States, have control over who's working at the Fed or not. That has to do with the government. So would they not, as far as their credibility be concerned, aren't they not just fighting to impress the people that gave them the job in the first place?
So those are great questions. Maybe I'm a bit of a purist in terms of the Fed, but I see them as being accountable to the U.S. consumer. Their dual mandate is for maximum/full employment, and their second mandate is for price stability.
Right.
We all know that the Fed does target a slightly inflationary environment. They are Keynesian in their school of economic thought, so they do believe that a moderate degree of inflation is beneficial or accretive to economic growth, and therefore a healthy job and labor market. So in my opinion, as it pertains to credibility, their credibility is being threatened at how well they're able to fulfill the key part of their dual mandate, which is to produce price stability. Mm-hmm. And so if for some reason their credibility does get lost, like, let me say it this way. We're in an environment where inflation continues to accelerate higher despite a more restrictive monetary policy where financial conditions are tightening and the Federal Reserve is raising rates in order to induce a recession and re-equilibrate demand at a lower level. However, if they bring upon economic pain via a recession, higher unemployment, but inflation continues to remain elevated, they're going to lose consumer confidence in that inflation expectations will become entrenched in consumer psychology. And that really gets back to this kind of concept that you may have heard. It's a very popular saying, don't let the inflation genie get out of the bottle. I used to hear Peter Schiff talk about this 5, 6, 7 years ago. And we're kind of finally in an environment where he's feeling vindicated about what he's been warning of. But essentially, if they are unable to keep inflation expectations hinged, then inflation will just continue to run rampant because eventually it becomes somewhat of a psychological issue in addition to a monetary printing issue, in addition to a supply side constraint issue and all of these different things. So the Fed needs to maintain their credibility in order to prevent a psychological run of inflation, if you will.
Yeah, I think it's interesting, and I like how you preface that saying you're a purist. What I'm really wrestling with, and again, I really do hope I'm wrong, but even the limited research I've done on this, because I know there was an article. If you just Google who can fire Jerome Powell, if you were to do that, there's actually articles. Donald Trump knows he cannot fire Jerome Powell. So I guess he tried at one point. And then from my limited research, it looks like what it had to be Congress and the Senate getting involved to replace. It might not even be a full-out firing. It might just be replacing him as head of the chair. I think the president is involved with appointing people that work for the Fed, but they cannot remove them. That's when the Senate and Congress have to get involved. And in which case, now we come back to the discussion again. We're kind of having to put our tinfoiled hats on and talk about conspiracy theories here, but we talked very, very heavily about the fact that primaries are coming up. And guess what? We're not going to see a new president based off these primaries. We'll see new candidates for the Republican Party to most likely rival Biden in the next election. But we will see a change in Congress and Senate. We will see those start to take swings. And would it not be of his best interest, knowing that a lot of more conservative and Republican-minded people are not the biggest fans of Jerome Powell? It seems like his only camp to really stay in any type of power in the Fed would be to keep Democrats in power. Is there not anything that you believe that could force him to potentially take the statistics that they want us to believe, and that is, inflation is peaked. It's done. It's actually overinflated a little bit. Like the numbers are overinflated. I remember Elizabeth Warren at last hearing that she was actually questioning Jerome Powell, and she really stressed, if you keep raising these interest rates, is this not going to hurt people's jobs? Are we not going to have a problem where people can no longer afford food and they're going to end up losing their jobs? In which case, she was insinuating her desire was for him to keep interest rates low. How much do you think that's going to play in? I want to hear T. Shroom's thought on this as well. How much do you think that will factor into Jerome Powell knowing more than likely with a more conservative Congress and Senate, which could happen in a change, that he could lose his job? Is he not motivated at all to go with the numbers that more Democratic leaders are kind of issuing him?
So I think those are all really, really great points and worthy considerations. The only pushback that I have several reasons to push back, but I think one of the main, with all due respect, one of the main things that I think though is that at the end of the day, I think Democrats can, let's suppose this, let's say the economy goes into a recession and inflation remains elevated. In that environment, the Democrats could point and blame the Federal Reserve, which they did not elect.
Okay.
So, whereas if they put in a new Fed chairman, if they go ahead and they remove Jerome Powell and put in someone like, let's just say Lael Brainerd, where it appears that she's really kind of being primed for the next chairwoman position. If they put her in and those problems continue to worsen, or the problems finally come to fruition where we enter somewhat of a stagflationary period, then the Democrats are really going to get blamed for what's happening in terms of the inflation side. At least right now, they can look at the picture and kind of remove themselves from the Fed in terms of being able to say, hey, look, we didn't elect Powell. He was put in by Trump, and here we are. So that's my initial reaction to that. I don't necessarily see
interesting. Okay.
Yeah, I don't see Powell getting removed, to be honest.
Yeah, no, and it's just something I want to explore down the road. But I just thought it interesting when you were talking about credibility. It just made me really start to ask, like, okay, who's he? Is he trying to remain credible to us? Is he trying to remain credible to politicians? Who's he remaining credible to? Because like I said, I do believe for a large part he's already kind of lost a lot of credibility. But I want to throw it to T. Shroom. Same question. Hear your thoughts. What do you think could be happening there? Do you agree with Caleb? Do you think there is potentially some conspiracy theories sitting there as Jerome Powell motivated in ways that isn't just his personal credibility with the public, the U.S. people?
I think that it's absolutely certain that Jerome Powell has multiple audiences that he's aware of, and at different times in the speeches, especially in question and answer session, he definitely seems to address specific audiences over others and at different times. But when you kind of saw the back and forth between Trump and Powell, you kind of felt that at the end of the day, Powell was going to do what he wanted and what he felt was best for the institution of the Federal Reserve, and obviously for the economy, for unemployment, for jobs, and for the interest rate, which is less of an issue at the time. Yeah. And I think that hasn't really changed. I don't really have reason to believe that the Democratic Party has some kind of special behind the door relationship with the Fed, but perhaps it's the case. Perhaps the Biden administration has a firm grip on Jerome Powell. I just don't think that's the case though, I think that the Federal Reserve, although they are misguided sometimes in the decisions that they make and in their overall premise of using Keynesian economics to guide their policy, I think that they believe they're above kind of the 4-year executive branch cycles. And I personally think that they are. I think they have a much more important but different responsibility. So yeah, I think Jerome Powell is going to be acting independently of the influence of the Biden administration. I personally think that he's very little concerned with that administration and what they would wish would happen. And I certainly don't think he's going to be taking their flawed definition of a recession into consideration. And you'll see if he does try to answer it, any kind of those questions that come up in the question answer session. If he tries to answer it in those ways, that will definitely prick some eyebrows, and people will definitely be paying attention to that, because that would be a change in mood and a change in power dynamic between the two major institutions there. So, but good question, Tim.
Yeah, what are the odds you guys think that one of the reporters asked him what the definition of a recession is?
I would definitely ask him that.
Last time I made a guess about something I really wanted one of the reporters to ask, it was the very first question. So I would very much find it amusing if the first question asked here around 2:30 is going to be that.
I remember what it was.
Oh man, yeah. Last month, those of you who don't remember, it was.
I remember it.
The question was, "Hey, Powell, last month you said that you would need to see months of data before raising it above 50 basis points, and now you just jumped to 75." That was the question last time. Now that I'm saying, I started as a joke. I would be very surprised if that isn't the first question.
It was crazy that at one point in time, Jerome Powell out of his lips said 75 basis points is not on the table as of now.
Yes,
we weren't really communicating about that, and now that's the standard.
And how the times have changed. Earlier this year, they made it seem like they were just going to keep kicking this down the road, and we didn't need to worry. And I remember back when 50 basis points was seen as a super hawkish move. And now we're looking at 75 basis points as a dovish move. And he's actually preserving the economy and not going hard on it by staying at 75, not going to 100. It is really interesting. It's been a fun year so far. Let's check in on the chart real quick, Smay. Something I said earlier, and we have a wick above, and we're technically right above it now. But remember earlier on Coffee and Crypto, those of you who watched it, I talked about on Fibonacci retracement, that 0.382 level. Watch us, hesitate right there. If I were to go down to the 5-minute chart, you're going to see we're starting to wrestle after a big wick. Wrestling right there. But with that wick coming down and the fact that we are growing green candles on those 5-minute charts, the next spot to watch, I'm going to keep an eye on now that we've kind of slowed down the momentum. Watch throughout this speech. Let's see if we peak out and get around 22.4 or maybe even up to that golden pocket around 22.8 to 22.9 or so. And then bearish, of course, maybe retesting, coming back down to around 22,000, potentially even coming back down to a good support level we've had for a while now, around 21,700 that we broke through with a lot of ease after kind of wrestling with it here for a couple candles. It is going to be interesting, but yeah, no, I would be very surprised. I'll keep my eye on it. I'm not going to interrupt the stream, so just in case anyone's wondering, what we're going to do, we're going to kind of wrap out our concluding thoughts here over the next 8 minutes, and then we're going to listen to about if it's still interesting, around 250, we'll stay, but around 255 or so is when we'll probably kind of close that out, come back, kind of wrap up what we think is happening there. So make sure you don't tune out. You're going to watch that and get our response afterwards. But keep those points in mind throughout the rest of the next half hour and even past that. 22,000, 22.4, and then watch 22.8, 22.9 come into play. And if we break through those, then there's a lot more that can go up there. But I'm going to start with just those levels for now for significance. But I'm going to throw it to you, Caleb. Let me hear some of your just concluding thoughts you want everyone to know. What are you thinking on right now? What are you hoping and expecting to hear here in just a couple of minutes?
I think the market is digesting the 75 basis points as smoothly as I think we could actually hope for. When I look at bonds, they're still up more than 0.5% today on 20-year bonds. So, the bond market is seemingly celebrating from this. Yields are still negative on the session despite a 75 basis point rate hike. The US dollar has actually flipped negative. It was actually positive earlier this morning after our morning session, and is now down 0.15% today. So, I think generally speaking, the market seems to be taking this in stride. And I think in each of the past press conferences, we've seen Powell's comments either reaffirm or reverse the market trend immediately following the press release. So it's going to be interesting to see how the language that he approaches this particular press conference and the severity, not the severity, but basically depending on how challenging the questions are, how much they push back on the Fed and Powell about why they're only going 75. Why didn't they do 50? Why didn't they do 100? Why did they kind of settle on this area? What conditions are they looking for to raise by 100? Like that would be a question that is on my mind. At what point would the Fed really consider and move 100 basis points? Because I mean, I'm clearly not on the board or a voting member, right? But if I was, I think I would have gone with 100 bips today. The Fed is still at least 1.4 or 1.5% behind the neutral rate. So moving by 75 basis points and having 2 months before their next policy meeting is a very big gap. So a lot is going to come down to how aggressive or passive is Powell in this press conference. What is the message that he's going to stick to the market?
I agree. I 100% agree. How about you, T-Shirt? What are your thoughts?
My thoughts going in, well,
and what are something like just like that? What are some things you want to hear or you're looking to hear some more clarity on in this press conference?
I'm looking for someone to ask a question about the Matt Damon factor for sure. To kind of see, I'm just kidding.
I didn't know you were going with this, so I was gonna let it keep going. So thank you there, Smay. Thanks for the laughter.
No, but just for Jerome to call Matt Damon out personally for misleading consumers. But no, if you go to my screen, I'm kind of tracking the difference between what's going on with Bitcoin and Ethereum and the dollar. And so here I've got the NASDAQ at the bottom left side, and that is pretty much unchanged. It's waiting for the briefing clearly, whereas Bitcoin has gone ahead and shot up its candlesticks. Now this is the 1 hour chart, up 2.75, you could say, 2 3/4 up. Dixie coming down on the rate hike.
Yeah.
And oil pretty much unchanged, although now it is kind of printing a little bit lower of a red candle here. But Ethereum looking very, very similar to Bitcoin, trading almost exactly the same. So, I'm just looking to see how these candlesticks change as the press conference goes on. But in terms of questions, like I said this morning on Coffee and Crypto Live, I'm really interested to see how he answers questions about unemployment and see if his tone shifts at all on that, because they could have some privileged data on, perhaps looking into the future and seeing people start to, not find jobs and start to actually be unemployed in the definition of the economists for this government has set up. And that's not going to be good, because that can, like Caleb was explaining this morning, that can lead to stagflation, and which is the opposite of what we want. And it's definitely not what the Biden administration wants going into the
this whole
primaries.
this whole year, I want to make sure I've given Jerome Powell some pretty harsh criticisms. I don't envy his job. This whole situation is like defusing a bomb. You do one thing too much to the right, you're blowing up. You do anything too much to the left, you're blowing up. It is a hard job. But, we got 3 minutes. Smay, how about you? What are you most excited about to hear here in 3 minutes from Jerome Powell? And I'm sure one of your answers will be a joke, but you usually still have some good stuff.
Yeah, I was about to ask. Do you want a silly answer or a real answer?
I will take a very short, silly answer, and then I'll take it.
Okay, silly answer. I hope to hear Jerome Powell talk about Matt Damon's effect. That was my joke. Now my real answer. I kind of agree with Caleb. I want to see how aggressive or not aggressive he sounds, especially with how long it is until the next interest rate hike. I really am looking forward to hearing, is this is he going to try to downplay what's happening and feel very confident in the decision they made, or is he going to sound very aggressive and make it sound like, oh, there's more to come? I think that's going to kind of telegraph, not to say that they've never, ever went back on what they've said before, but I could definitely see it choreographing kind of what to expect come the next Fed meeting here in September. So,
yeah, this is the meat and potatoes as we kind of wrap this up. Does it say how much longer we have till he's necessarily live? I don't know if he goes live right at 2:30.
He did last time.
But just kind of wrapping all this up, this is what we're about to hear is going to be the meat and the potatoes. So make sure you pay attention to every single question and stick around for our thoughts afterwards. But every single time, for the last 3 months when we've been doing these live streams, we've all gone into it thinking one narrative, and it comes out with something very interesting and very different that kind of gives us a look into the future. And this is the first one we're going to have to wait 2 months now to get a response. This is our third live stream we've done with watching Jerome Powell's interest rate hikes. And it's going to be interesting. Again, what is the recession? I think that's a big question, and I made that almost as a joke, but I actually think it's really important that we know from Jerome Powell's lips himself, how is he viewing currently what we're going through? Are we in a recession? Are we going with the old, more traditional narrative and definition of being 2 quarters of negative GDP? Is he holding off and saying this isn't a recession because the job market still looks really good and because they don't deem that people are using credit cards in excessive levels to fight inflation? I think that's going to be one that's really important. And then the other one, T. Shroom and Caleb both kind of locked up together was, hey, what is the narrative he's giving about the future, and what does it look like? Is he really afraid for inflation itself, and is that going to take precedence so that he can keep his name, pretty much have recognition and be respected by people? I question how much he's concerned about it, but at the same time, there's a good chance that maybe he goes that route. So, with that being said, is he live?
It's time.
Let's
it's
do
time.
it.
You are perfectly
We'll talk to you
timed
again afterwards. Smash that like button, subscribe, and we'll talk to you here in about 30 minutes.
All righty.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer-run goal. This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from The Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, we continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral, and I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and of all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some additional tightening, significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times, what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be. I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the best data, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated. Has your view of the terminal rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jerome. Thanks for taking our questions. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level, ultimately, at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions. And those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down. And we, as I've said on other occasions, price stability is really the bedrock of the economy. And nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions, when that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason is there are just too many areas of the economy that are performing too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market. And it's just not consistent with, 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Hi, Chair Powell. Victoria Guida with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight. That actually you won't be able to make trades unless they're pre-cleared, and the amount of trades you make will be they'll have to be 45 days or more before any FOMC meeting. It's just I think we've really created a very strong and robust set of rules that will support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
All right. We are going to cut it right there and kind of discuss this, break it down for the next 15 to 20 minutes or so. Very interesting, very interesting. A little bit of what we expected, maybe a couple things we didn't. I'm going to start off by kind of pointing out what I think was big, and I want to make sure people understood what he was talking about when he said it. And I'm open if you guys got a different read on that. Very open to you guys saying, Tim, you disagree. But he said a lot of different things about the numbers, and he used the phrase, what was it? It's not significant. He talked about a big number. What was the word he used there, T-Shroom?
I'm not sure.
He talked about a big number. Matt C mentioned it in chat, and I responded to him. Significant boost or something on that line.
Unusually large.
Unusually large. Thank you, Caleb. Unusually large. So at first when I heard it, I thought he was talking about 100 or maybe 125. And then when you start to piece together the other things he was talking about, no. Because later on when he said unusually large, because he said it at least twice, if not 3 times, he said another unusually large increase. What have we done? And he mentioned that we've done it twice in as many months. He just did 75 basis points. So he's defining, not that 100 couldn't fall into that category as well, but just, if we did 75 again, he would see that as unusually large. The other thing that I thought was really significant was that he said by the end of the year, he thinks a safe spot would be for the interest rate to be around 3.5, 3.25 to 3.5. Well, guess what? After this 75 basis point increase, that puts us at 250, 225 to 250, which means we have 3 more meetings. And he only is expecting us to be up 100 basis points from this point. That is kind of going with that narrative of that question. Could he potentially do a 75 this month, 50 in September, 25 in November, and then another 25 in December? That would give us 100 basis points increase to 350. So if anyone was wondering, he did protect himself. He did leave things vague, whereas in the past he kind of hinted at, we're not even considering 75 unless the data, unless we see multiple months of data. And then he realized that was a mistake. I should not have not given myself an out. He gave himself an out. If they go 75 or 100 or 125 next meeting in September, then technically he did open that boat. But everything he talked about very much leans like he is hoping and wishing that the rest of this year we will see a decrease in interest rate hikes. So if anyone was wondering what that phraseology meant, what he was going with, he did keep it a little vague. He did give himself some wiggle room so he can change things down the road. But that's what that language meant to me. Caleb, do you disagree? Do you hear it differently, or do you agree that that's kind of what he was trying to communicate?
No, I mean, I think you're spot on, and I definitely was paying attention to that as well. I have a Word doc open with just some different notes. But I think First and foremost, I think we talked about this a little bit this morning, but at the beginning of the year, the market was only pricing in 2 to 3 rate hikes for the entire year, which would have been 0.25% for each rate hike. Here we are for the second meeting in 2022, raising rates by 3 rate hikes equivalents, right? And so this is only the second 75 basis point rate hike, I think, since 1994 was the first one, and then the June meeting was the second one, and now we have the third. So first of all, it's very rare for the Fed to be raising at this pace of 0.75%. So I liked the way that he said it. These are unusually large rate hikes. With that said, as we were kind of having a preview of the press conference, I was saying I expect Powell to give himself a lot of wiggle room and the Fed a lot of wiggle room to see how the data evolves between now and the September meeting. He mentioned it himself. We're going to have 2 big labor market reports, and we're going to have 2 big CPI reports between now and the September meeting. So depending on how the data evolves, I literally did a tweet and I was like, the Fed seems to be taking a wait and see approach with regards to inflation.
Yeah.
So I think that really summarizes it.
Yeah. That is true. Yeah, you got that one head on. T-Shirt, what about you? What were your thoughts?
Yeah, so I wrote down a couple of thoughts. It seemed like he said that a 100 basis point hike was on the table. Like he was ready to use all the tools, and that when the 1% question was asked, he didn't deflect and say he's not going to do it. He said it was on the table. So
right,
giving himself plenty of wiggle room. But then I did see that he had said that a path to a soft landing has narrowed and may narrow further. So that's discouraging for sure. But then one thing that was pointed out that I saw was that the Fed no longer mentioned the China pandemic lockdowns in their briefing. That was not one of the factors of consideration. They did include the war in Ukrainian invasion, but not the China pandemic lockdown. So that's something that they're no longer considering. Although the market, you still hear that quite a bit as market participants and market analysts definitely are thinking that those lockdowns in China are keeping having an effect on international markets. But during the briefing, the NASDAQ was getting bought. So folks were buying that briefing. Yeah. And Bitcoin had led the way. Actually,
Bitcoin's up at 22.6 still.
If you want to go to my screen, I've got the 4 pulled up, and then we can
Bitcoin touched 22.7.
Yeah.
It touched 22,700 and then came back down.
Yeah. So, and then the NASDAQ, it was waiting for that briefing very clearly. Yeah. Oil unmoved for the most part. If it hadn't been moved, it is moved to the bullish side. But yeah, so other than that, I was really surprised to say that we're not in a recession. Like, are you taken seriously? I just don't understand that. It doesn't. Yeah, 1 + 1 does not equal 2 for me with that. I don't understand how that can be.
I was worried there for a second because the first time the recession was brought up, they didn't really ask it very clean. They kind of they got him to answer that I could take from his answer that his opinion was that we are not in a recession, but I'm glad that someone else followed up and said, "Do you still hold off that we're not in a recession?" And he said he didn't. And here's what I was telling T. Shroom and Smay off air. Caleb couldn't hear me because with being Zoom, he got disconnected from us. But I was listening to something this morning, and I cannot for the life of me remember who. I really wish I could give them credit because they deserve the credit. So if someone else heard this and you guys remember who was talking about this, please put it in chat. I'm not trying to steal someone else's thought, but they were discussing the same thing actually happened back in 2008. That actually there was the 2 quarters of GDP negativity. There was negative GDP growth. That it was very clear to a lot of people there were issues, but because the job market was good, but because there was a lot of other factors, they held off calling it recession. And sure enough, within a couple of months, the housing market crashed. Jobs started to go away, and none of us. I mean, we look back. Is there any debate that 2008 was a recession? No, none at all. But they actually started their recession with the exact same issue. That they were in a recession by the definition of 2 quarters of negative GDP, before the politicians would actually agree and admit that they were in one. And of course, that was rough. So on one hand, this is kind of bearish, and this is kind of bad in two different areas. First of all, the fact that he's not admitting we're in a recession, the fact that the White House is not admitting we're in a recession, the fact that they're still focusing, now that puts their focus back on inflation, while there was remarks he made that he doesn't really want the rates to be very high. Just so you guys know, as long as they stay in denial of being in a recession, that'll give them the encouragement to try to keep the interest rate hikes up, right? That's going to be bad for Bitcoin price. I think it's good for the economy long term, but if anyone's wondering, hey, Bitcoin go up, Bitcoin go down, well, if interest rates go up, Bitcoin go down. That's how that's when it's going to work. The other thing is that as long as they put it off, we're just going to keep kicking the can down the road to where the recession just elongates, in which case now there's also the question of, a lot of people are hoping, and there's a lot of signs that show that maybe October, November is a good spot to look for potential bottom and then a resume to the bull market. Could that be delayed because of our mishandling? Like, could Bitcoin be entering into a bull market in the middle of the U.S. economy going into recession? We've never seen it before. Bitcoin didn't exist when there was the last recession. We've never seen Bitcoin go through a recession. So I'm interested to see what happens to the price if that happens. But just so you guys know, again, if you guys, I haven't seen in chat anyone mention it, but if you guys heard that as well, there was somebody talking about it this morning, and I thought that was really interesting. But I'm going to throw it to you again, Caleb. Let me get your closing remarks, and then we're definitely going to have you on the channel again very soon. We'll talk off air, and we'll get you on soon. But what are your overall thoughts? Is there any change to what you thought the future looked like, or is it pretty much exactly what you expected?
This is a massive curveball, I'm not going to lie. I'm really shocked at Powell's press conference. I think as far as the 75 basis point rate hike goes, that was exactly what the market was expecting. That's exactly what I was expecting. But I certainly expected him to come in, leave room for flexibility, but to reaffirm that the Fed is going to continue to kind of keep the foot on the gas pedal and fight these inflationary pressures. With that said, though, it really does feel like the Fed is taking a wait and see approach with respect to inflation. One of the key things that I thought Powell did say during the press conference was that he believes that the current rate hikes that they've already done have not fully had their effect on the economy yet, and that could take some time for that effect to come to fruition. So the Fed is operating from a standpoint that believes that their rate hikes that they've already done are still going to have an increasing effect on economic conditions. With that being said, Powell also reiterated, and this seemed like a complete 180 to me, he's now saying that the Fed is not necessarily targeting a recession to bring inflation down. He's saying we don't need a recession. I thought the whole point was that they were trying to re-equilibrate demand at a lower level. That's the whole point of these rate hikes, to create an inverse wealth effect, to increase debt servicing costs, so on and so forth, in order to bring demand down. But now he's saying that we don't need a recession in order to do that, even though the job and labor market remains extremely tight. So again, it's like he's trying to toe this very thin line of being strong on inflation. But in my opinion, this was officially the first the first dovish press conference that I've heard Powell give in quite some time. I'd say for the past year or so, we've heard a lot of hawkish rhetoric from the Fed to reaffirm the fight against inflation, even though they were admitting that, inflation is going to be transitory for the longest time. But this really felt like a dovish turn, in my opinion, because like we were talking about in the pre-show and in this morning show, what happens if inflation does continue to accelerate higher over the next couple of months? He's now seemingly taking their foot off the gas pedal from a rhetoric standpoint. And make no mistake, rhetoric and forward guidance is a policy tool in addition to raising rates and or balance sheet runoff. So this was a massive curveball, in my opinion. I'm still going to really absorb it. And I don't know. We'll have to talk about this more.
That's a very good point, Caleb, is that, this is just our initial reactions. You guys are definitely going to have to tune in again, here me and T-Shroom tomorrow morning, and we'll get Caleb on again very soon. I'm sure he's going to form his stuff, get in his newsletter and on his Twitter. And he has a YouTube channel as well, so make sure you guys follow his YouTube channel as well. But we're going to get him on probably at least, if I'm not talking off air, but maybe early next week. And once we're able to digest all this, we'll be able to regurgitate some more information. But I'm going to throw to T-Shroom for his final thoughts, and then we'll be wrapping it out here.
Well, I was expecting a more confident Jerome Powell, and I don't think I got it. I think he was, he looked a little bit more worried than he did confident, and I think that only deteriorated. His confidence deteriorated throughout the press briefing and throughout the question and answer session. And again, it just does not compute to me how he can get up there and say that we're not in a recession. It does not compute to me. I mean, even though the labor and the wage markets are robust, the inflation is at 9.1%, Jerome. This is a serious issue, and he knows it's serious, but it's just this weird contention over that term recession right now. I think is getting to me.
My final thoughts, and here's where people have asked, Tim, is your opinion changing? Because I've been in the boat of I don't think the bottom is in yet for the crypto space, for Bitcoin. I don't think my odds in my brain have changed. And again, I'm not saying that we absolutely have to go lower. There's still some chance out there that the bottom is already in and we're going up. But I think what we just heard, and I think that potentially the scenario we could see play out, is actually some bullish momentum for Bitcoin here short term. I think that we could get over 30. What's in my brain at the moment is could we in Bitcoin maybe even jump 30 and start heading towards 40 before the irresponsibility and the inflation catches up. This denial of the fact that we're in a recession finally catches up with us. The job market crashes. The economy crashes. Things just go down the tubes. And there's a very, very quick and very, very few number of candles that crash us down lower than 17,600. But then there's a V bottom and we start to resume the market. I'm still sitting in a boat of thinking that is very much really on the table. But we will dive into more of that each and every single day here on Crypto Jebb channel, because no matter what happens, we're going to stay up to date on everything happening and keep you guys updated. So if you guys want to keep in the loop, make sure you subscribe to the channel. Smash that like button. We had over 1,300 people watching, only 368 likes. We can get those likes higher. But with that being said, that's all we have for you guys today. Make sure to tune in tomorrow morning, 10 a.m. Eastern Standard Time, for the next episode of Coffee and Crypto Live. And I'm sure we're going to have a lot more for you to digest what this means for your crypto holdings. With that being said, guys, I will see you in the next video. Peace.